All right, Monday morning, let's go. It seems like the weather's finally broken. Thank God. Didn't get that video out Friday about Harry Potter. I'm going to probably tomorrow. I apologize. I got slammed last week and the weather jacked me up. Anyways, moving onward, moving upward. Wanted to talk about today just some more entrepreneurial concepts. I know last Monday I talked about daily rate, how to think about your money per day, whether that's 2 hours or 4 hours, 8 hours or 10 hours of work, whatever you did. But what I wanted to talk about today, I had a really good conversation with my brother-in-law who works for a very high level, very successful. They do a lot of sewage drainage and they move a lot of earth. I really don't know specifically what they do, but we just got to talking about his company and his boss. Hopefully I'll get a chance to interview him. But we were talking about how with his industry, the necessity for access to credit, and in his own words, what he said was, if we don't have lines of credit open, if we become an all cash business, he said our bonding agents, or I don't think I'm saying that right, but the companies that provide their bond, insurance, whatever the case may be, he said most likely would drop them because at that point, if you operate entirely in cash, you don't need them. And also too, cash is very easily made to disappear. So just thinking about that, here's this large business that does, I think, like 80 million a year, very successful. For that business to thrive and succeed, they have to have access to credit, and they have to show their insurance company, their bonding company, however you say that, I don't really know, that they have revolving access to revolving lines of credit, as well as just credit in general, maybe like a secured credit line or whatever the case may be. And it got me thinking, again, this isn't about credit cards, but this is to think about credit in a different way. If we start to see ourselves as business owners, even if you work for somebody and you have a 9 to 5 or whatever, my wife works 6 to 3, whatever the case may be, start to see yourself though as an entrepreneur, as a business owner, concerning your finances and really the importance of credit to manipulate it on your behalf, whether that's a home equity line of credit, to absolve debt, doing a cash out of your house to put all your debt into your house and then sell it to sever that debt from you. Thinking about it in that way differently, because credit gives us access to options that we don't have when we're just operating solely with cash. It's just the way it is. Cash alone cannot give us the access that we need to make financial moves, to secure wealth, to pay off debt as easily as having the combination of credit and cash. And again, whether you're someone who agrees with my philosophy on using credit cards to pay your expenses or you're not, there's a lot of great concepts to chunking the mortgage, purchasing properties that you can flip, that you can put portions of your debt, if not all of your debt, into said property, then selling that property to another individual, thereby severing the debt in its entirety or in part from you. Because here's something that's very important. Although I'm a little more aggressive in my concepts than someone like Dave Ramsey is entirely accurate. The best way to succeed in retirement is to be debt-free. That's it. Now, there's two ways you can do that. You can do what my wife and I are going to do, which is where we're going to pay $200 to $400 extra a month on the mortgage. Once I get the company set up, we're going to start chunking the mortgage. We're going to put $5,000 down on the mortgage, on top of paying the mortgage monthly, on top of paying extra, and then pay that credit card down. Then once it's down to zero, do it again, because that $5,000 or whatever amount you choose, it goes directly to the principal. That's actually a concept called velocity banking. I'm going to do a video about that later. There's some great things to it. There's some really dangerous things about it. So I want to talk about that later. But whether you want to do what my wife and I are going to do, where we're going to pay down extra, we're going to restructure the loan and continue to pay the same amount to pay it down as fast as possible. Whether you do that or you decide to just make the payments as you go, and then when you get to your retirement age, you liquidate everything, which there's benefits to both. but there's risk to both as well. And I'll talk about that in a later video. But how can I say this? Whatever path you take to become debt-free when you're retired, what's important is that you become debt-free, because most likely, unless you're a high earner or you're someone who's just really willing to sacrifice now for a greater wealth later, most likely when you retire, you're going to be operating with less income than you did when you were working in your working years. It's just the way it is. Most of us, that's what happens. And that's okay. That's I believe, part of the life cycle of working, and as well, it's part of the life cycle of just us as humans. We progress, we move forward, we have this peak earning potential, and then once we hit that peak, we retire and we start to go downhill because inflation continues and our money probably stays the same. Hopefully what we've done is we've created enough wealth for ourselves that we don't run out of money for the rest of our lives, and our money is still valuable enough where it can keep up with inflation so that we're not losing money hand over fist. That's obviously a different discussion for a later time. But my point is, thinking about your access to credit, lines of credit, not to get what you want, not to go on a shopping spree, not to, do whatever you want to do, but really to allow you to operate in a much more aggressive manner. This is what the wealthy do. This is what successful business owners do. And I think at the end of the day, the main difference between the wealthy and between the wealthy and the middle class and or the poor isn't even necessarily income. Yes, the wealthy tend to operate at a higher level of income than middle class folks and poor folks. That's true. But at the end of the day, I truly believe it's all up here. It's all how we think about our money and how we want our money to operate for us. And the fact of the matter is, you can't cause your money to work as aggressively for you without manipulating at some point lines of credit. It's just the way it is. And again, there's different ways to do that. You could buy a house that is been foreclosed on, that needs some work. You buy it, you fix it up, you live in it for a year or two. You then do a cash out to get all of the value of the house that you can out. You take that money that's now borrowed money against the house, but it's a pile of cash in your account, and you go absolve all of your debt or a portion of your debt, and then you sell that house. There's a lot of different ways to do it. You don't just have to use credit cards. There's my main business, Kerman Home Services. I work a lot with real estate agents, real estate developers. They do this all the time. They're constantly buying foreclosed properties. They're constantly buying fixer-up properties. Many times they put the minimal amount into it they can to make it as profitable as they can, which can be dark. But anyways, and then they absolve all the equity out of it they can and either use it for investments or use it to absolve other debts. And they basically just keep leapfrogging all the while they are acquiring properties that they end up paying off very quickly, that now they have the entirety of the equity available to them, or they have the entirety of that monthly rent check. So again, there's a lot of different ways to do it. And whether you're working for someone else or you're doing your own thing is irrelevant. It's irrelevant. Think about your money, your access to credit as a business owner. Why not? Like, this is why it's a mental thing. The middle class, oftentimes, we don't think about our money from the standpoint of what it can do for us. We oftentimes just think about our money from the standpoint of what it can get for us. And that is, I don't care what anyone says, that's a lower way of thinking about it. That's a lower frequency, if you will, whatever. And it's really not hard to change your way of thinking. It's really not. You just have to be able to see the benefits of, one, sacrificing a little more and not going out to eat as much. My wife and I, we still struggle with that. Not buying, spending the money you want to on Amazon or whatever store, whatever the case may be. And not only sacrifice, but also too targeting your money in such a way where it does more for you. It's extremely powerful and it's very capable. But one of the ways you can do that, again, is thinking like a business owner, like an entrepreneur, and how to have access to lines of credit and how to use those lines of credit to your advantage to hedge your cash so that your cash becomes more powerful for you and it can do more things for you. So I wanted to put that out today. I'm going to do a video here on velocity banking, the ups and the downs of it, because I think it's something worth talking about. But the point is, wanted to put that video out today. Gonna get the video that should have been out for Friday tomorrow. I'm excited. If you've liked it, like, share, subscribe, leave a comment. If you hated it, send it to someone you hate. Have a good one.